Hi, this is Andy Myers in for Tom Essay on Money and Markets TV. Last week, the European Central Bank cut its benchmark interest rate by 25 basis points, or 1/4%. That was exactly what the market was expecting, but another announcement did take investors by surprise. The ECB cut the interest rate paid to banks on money deposited at the central bank to 0%. The move is an attempt to get European banks to lend out the vast sums of money they have on their balance sheets, rather than hoarding it, which is what they're doing now. It makes sense in theory. Before the rate cut, banks could earn a risk-free 1/4% by depositing their money at the ECB. In a zero interest rate environment like we have now, that's a safer investment than lending it out to businesses and consumers who may not be able to pay it back. But now, the thinking goes, banks will be forced to lend out their money in order to get any return on their cash and maintain profitability. That would theoretically help money flowing into the economy and stimulate economic growth. But there's one problem with this theory. Banks have kept money at the ECB not out of greed, but out of fear. They don't love the 1/4% yield, they're just afraid to lose any more capital by lending it out. So there's no guarantee that they won't still hoard their money or keep it at the ECB. They might be satisfied with a return of their capital rather than risk lending for a chance of a return on their capital. In this scenario, the European banks would actually become less profitable, putting them in even worse financial shape than they are now. So while interest rate cuts and other moves to stimulate the economy are usually bullish for stocks, that might not be the case this time. It could end up backfiring, hurting the banking sector and dragging down the entire European stock market. One way to play this is with the ProShares Ultra Short MSCI Europe ETF, symbol EPV. This inverse ETF is designed to go up 2% for every 1% drop in the MSCI Europe index. We'd recommend waiting to see if European stocks get a bounce from this latest central bank move. If they do, it would provide a good entry point to profit from the next slump when the sovereign debt crisis inevitably worsens. Remember, this crisis won't be over until Europe moves decisively to shore up the region's banks. Even with the interest rate cut, the ECB continues to take one step forward and one step back. I'm Andy Myers for Money and Markets TV. Thanks for watching.